So I think when talking about balance sheet adjustments, it's if I know you guys are struggling to write it down, but it's laid out nicely on slide 78, where it just has everything. And there's actually a few pages in the book I'll assign as reading for the weekend that covers this, just so you have it down. Just note that those pages probably cover some modeling that we didn't get to yet. We'll get to that next week. Don't worry about the modeling, just worry about the concepts. We will do the modeling of Office Depot, Office Max next week. But the idea here is, again, in order to capture the balance sheet adjustments, you want to look to the uses and sources of cash to determine what adjustments to make. And when looking at the purchase price is broken up into several segments: the target book value and other purchase price allocation adjustments like goodwill and intangible assets. This is a simple form. So the target book value is an elimination to shareholders' equity. I have the minus on the left and the plus on the right. I don't know why I did that one. Goodwill and intangible assets are created. The other use, the net debt, if you're paying down net debt, is obviously target net debt. That's eliminated. Transaction fees, we assume, is part of shareholders' equity, be it retained earnings or other comprehensive income. The idea is this is a component of an expense that'll hit net income, that'll hit retained earnings. And then supplemented by the sources, which is some combination of debt and equity. New debt and new equity come into the balance sheet. So this is how you think about that. Let's model it. Do you guys have any questions? Let's use this to model out the adjustments. So as you remember, what we left off yesterday is we have a fully projected income statement, we have a fully projected cash flow statement, and again, we're at a point where we cannot, there's a big chunk of missing information in the cash flow statement. There's really not much. Well, there's some stuff here, but, and it doesn't make sense to use this to drive the balance sheet until we fill out this information. So we need to build out the depreciation schedule, the working capital schedule. Depreciation schedule is based on PP&E. Balance sheet item. Working capital schedule is based on current assets, current liabilities. Balance sheet line items. So we need to have, in a standalone model, you just look up the balance sheet from the 10K. We need to have a new combined balance sheet that we can use to drive the depreciation schedule, working capital schedule to finish the model. So underneath here, first, we've laid out the balance sheet. We're going to pull in the acquirer and target's balance sheets respectively, and those should balance, obviously. So I'm going to pull in cash from the acquirer tab, 2013 cash, and we're going to merge 2013. But remember, let me not forget, be careful about timing here. Income statement, cash statement, 2014, it's projected. We don't care about historicals. In the balance sheet, we need the historical actual balance sheet. The perspective is, let's assume the transaction is happening on December 31st, 2013. If it happens December 31st, 2013 on that day, we will have a balance sheet on that day to make our projections. We will not have a one-day income statement. The income statement and cash statement will be 1 year forward, right? I'm going to pull in the cash from the target balance sheet. I hope not. Okay. Check. You're right. It should be 105. Better? And again, this is a template. The nice thing about the template is the lines match up, so we can just copy this all the way down. We'll see next week when we do a case study. It's not going to be that easy. So, but I just want to make sure we're covering the high level. So I'm going to copy this all the way down. Control C. You can highlight everything down and do a big Control D, or I'm going to just paste special formulas to not disturb the formatting. I'll make it black. And yes.
You should probably try to model out just the actual changes, right, and the important line items as you did in this template. How common is it to more or less simplify more complicated balance sheet towards just these line items and creating other, just sum everything in the other just to keep it
consistent?
Keep it simple and
yeah. You can do that, and we'll look at those techniques when we see Office Depot, Office Max. I mean, In the balance sheet, it's easier because everybody has AR, everybody has inventory, right? And then you'll have these, if the one-off items will be strange ones, like other current assets, and you could say, you know what, let me just lump that into other current assets. Looking at that individually serves no purpose to anybody, right? So
Really add anything for the valuation itself.
right, yeah. So there are techniques to do that to make it line up to make the modeling simpler. Yes. Whereas it's tougher to do that in the income statement because let's say if they have operating expenses, those you really want to analyze because getting to EBITDA holds a lot more importance, right? So yes. So that's where I just don't want to. When I used to do this and dive right into Office Depot, Office Max, people would get lost in these little nuances. I want to make sure we got the high level and then get into that, but that's a very important point. And I think in the balance sheet, it's easier just to lump things into other buckets because they really don't serve much purpose. Yeah, absolutely. Liabilities, current liabilities, we'll delete. So to your point of highlighting the differences, we will certainly do that when we get to the case. That's to focus on what the differences are from a template to something that's real. And then just this is just left over from when I copied down stockholders' equity. There's no value here. I'm just cleaning this up a little bit. And this balances, and it should balance. Okay, so everyone should have this. Any questions on this? And then so I did pluses and minuses on the board. When I was modeling, we did, I don't know if anyone that's done this in the internship, you guys have seen debits and credits, or you do pluses and minuses. Yeah, in all fairness, at the bulge bracket banks, they use debits and credits. I think it's ridiculous, so in the book and stuff, I changed it to plus and minus. Why throw T accounting in there? But in an asset, a debit increases the asset and a credit decreases the asset. In a liability, it's flipped. In a liability, a debit decreases the liability and a credit increases the liability. So we want to be careful of that. To me, it's plus and minus. But let's do the debits and credits here, just so I'm teaching you guys both methods, and then the other one we'll do plus and minus. So when we set up our total column, we're going to set up our total column so that we can handle debits and credits. The total column is going to be the acquirer's line item plus the target plus the debits minus the credits. So this is going to be equal to acquirer plus target plus debits minus credits. And we'll copy this down for every asset. So I'm going to copy this formula down through the assets. So again, it's the acquirer. Yes. Acquirer. Oh, it's going on. I always get that backwards. Good? Too dark? Yeah. Okay. Yes.
So if we're going to build in a formula like this, going straight through, we're going to need to keep in mind debits and credits and how they flip when we get to the liabilities and the signs on each of those.
Yeah. It's annoying. That's why I don't care for that. But just to show you how it's done. And then just one thing in the total column, I wasn't so concerned about the individual columns because we're not really going to manipulate that. But the totals in the total column must total top down so that it captures the adjustments that we're making in the individual line items. So these totals must be sum top. Otherwise, it won't capture any individual adjustments, right? If the total is just left and right. So the total H116 must be a sum of the above. H123 must be a sum of the above, making sure you're capturing in also the row 116. And let me save this. Today's the 29th. And then, yeah, see, I mean, we have to reverse it now as we go down. You guys have this? Okay, questions on that? And for liabilities, it's reversed. So the liabilities are acquire plus target minus the debits plus the credits. So the logic is reversed there. D plus E minus F plus G, because of the nature of debits and credits. And it's actually the same thing for shareholders' equity too. So we can just copy this all the way down now for the rest of the model, all the way down through shareholders' equity. Oops. Oops. Okay. Minus debits plus credits. Okay. And we can just kind of, again, fix the totals in the total column so they total top down. So total current liabilities, obviously. Total long-term liabilities must include the current liabilities. This is just a header. The total shareholders' equity must include everything, and then we have the liabilities plus the shareholders' equity. And this should balance, right? The sum of two balancing balance sheets must balance otherwise, obviously. There's something wrong with your links. Question on that? And then we can go ahead and make our adjustments as we've drawn on the board. So what are some of the adjustments you think we should make? Where should we begin?
Start with cash, and just wipe out target's cash.
Okay, target cash is gone. That's part of the net debt. So to wipe out target cash, we're going to credit out the target cash. The way we do that is G111 equals to E111. This might look redundant. Why do we include it and then exclude it? But it's helpful if we ever end up updating the target model, if we end up changing the nature of the transaction. Doing it this way allows us to do that cleanly without, and it's easier to avoid error that way. Cash gone, right? We're left with acquire cash. What else? Well, why don't we stick with the net debt? Why are we jumping? Let's continue wiping out the net debt. So if we've taken out cash, let's take out the rest of the debt with it. And we're going to debit out the target short-term debt and the target long-term debt. So the net debt's taken care of, right? Net debt's gone. What else? What else do we eliminate?
We're going to take care of pensions, aren't we?
Not now. Not in this case. And you might not always. But we'll talk about that in the case. Let's leave it as is for now.
Can we take out the prepaid expenses?
No. Why? You get that. Operating. It's working capital. It has nothing to do with the sources and uses. Yes. Equity. Target shareholders' equity. Gone. Everything about it. Everything is always. Everything in shareholders' equity. This is what you're paying for. Right? 500. 330. Whoops. 100. Every component of it is gone. So you're left with just the acquirer's equity. You're paying a premium above that 934. That must go somewhere. And actually, I should have done the actual goodwill box before getting to this. So let's quickly do goodwill and the assumptions. This is a simplified version. There's I would say there's a better version in the Office Depot Office Max case that's got all the adjustments and is laid out a bit nicer, but let's just kind of, this is very much like the one pager that we did. But okay, this starts with the purchase price. And remember, it's the equity value of purchase price. If you guys are doing LBOs and your purchase price is based on an enterprise value, make sure to subtract net debt from it. The target book value comes from where? Target balance sheet. We can get it right from the adjustments that we did here. It's the 934.5. Or we can do it from the target balance sheet individually. It doesn't matter. And you subtract. Right? This is the price over book. This is what needs to be allocated to different pieces. Right? 25% goes to intangible assets. The remainder goes to goodwill.
Isn't EV supposed to be a ratio?
Huh? Say what?
Isn't price to book supposed to be a ratio, or is that different?
It could be a ratio. It could be a ratio.
Price to book is the price you pay over the book value.
But this is,
Over the book.
yeah, price book value is a ratio, but that's not what we're doing here. That's okay.
Why that happen?
That's fine. That's a fair question. Okay, and then we can, now that we're here, we can calculate the amortization by, this will ultimately go to our income statement and cash flow statement. It's the price over book. We're assuming 25% of that will be amortized. So times 25% divided by 15. That's just the amortization. Right? No, by the order of operations, it'll automatically multiply in order. Yeah. Nope, they're on the same level.
So then that amortization per year is what we put into the goodwill, or is it the total?
This is an income statement. This is amortization. This is an expense.
So it's the total price over book that you put into goodwill, and then the amortization is just what goes into the income statement.
75% of this is goodwill. 25% is intangible assets. Yeah, we could have laid it out a little bit better. In the next model has it laid out better. Okay, so let's do that. So to your point, so let's say intangible assets. Here it is. The acquired, identifiable, amortizable intangible assets is an increase. So that'll be an F119, and that equals to, from the assumptions tab, 25% of the price. So it's 3128 times 25%. 25% of that. It's a quarter of that. The remainder, the 75%, is goodwill. And so we can just subtract, say the remainder, or we can do 75%, however you want to do it. But I would just make sure it's a formula so that you can always adjust that 25% and it will flow. So what I'd recommend doing for a goodwill, I'd say just make it 1 minus 25%. So this is going to be equal to assumptions, price over book, times, this has to be in parentheses, right? 1 minus 25%. So the remainder is in parentheses. Got it? So the sum of obviously the goodwill and the sum of, the goodwill and the intangible assets is the price over book. Anybody have questions on that? Okay. Yes. The what's one?
The 1923 whatever.
This one?
Yeah.
Just a sum of everything from above? Including the 96267.
Because my Total assets is the. And it's.
Does it include this one, the current asset?
Oh, hold on.
Mhm.
There we go. What's it?
Got it? Okay. Next. What's next? We handled net debt. Okay. You can't see this, but we handled the net debt, the purchase price. We handled all components of the purchase price, the book value, the goodwill, the intangible assets. We handled all components of the purchase price. We handled net debt in the uses. We are now left with fees in the uses, and we are left with the sources of debt. The sources, debt and equity.
First, we could just get rid of the fees from retained earnings.
Yes, fees are an elimination, to retained earnings. So you can also make it an other comprehensive loss. So either way. More people just do it in retained earnings. I actually think it's more accurate to have it the way the rules keep changing. But anyway, but just the way I've seen it in models and the way, you would just add an additional reduction, right? Column F is a reduction. So I'm going to, right now it equals E141. I'm going to tack onto that a plus, an additional reduction that's going to link in from the fees of 100. It's going to reduce further by 100. Okay, you got it? And then what? Now we have the sources to deal with, right? Sources are represented by here, in this case, very simply, 2.1 million in equity, 2.1 million in debt. Equity is coming into the balance sheet, debt's coming into the balance sheet. So let's bring in the equity, that's column G. We're going to credit in. We'll take it in as common stock, G138 equals E6. And then finally, the debt. We'll take it as long-term debt, G131 equals E131. So we have debt, equity, and if you've laid it all out, it should balance. Because you've captured properly all the uses and sources into the balance sheet. These are adjustments, so I'll make them black. And your debits should match your credits. Right? Do they? I hope so. You have 4962.5 in debits. 4962.5 in credits.
Paul, question about deferred tax assets liability.
Yes.
In Breaking to Wall Street, Brian removes the targets, DTAs and DTLs. Why is that?
And we'll do that in the Office Depot office price, because that's part of the purchase price. That's one of the purchase price is book value, intangible assets,
Okay.
goodwill, deferred tax adjustments, old goodwill. Right up. We didn't get into that level yet. We'll do that next week. But the thought process is those deferred taxes were admissible in that tax structure. Now it's no longer, and that's just an example. It might be, but usually they'll get eliminated. But I want to keep it high level for now. Yes, Toast. Yes. Did you have a question?
For the one,
Right here? This just comes in from the debt on the assumptions. Yeah, make sure you have it from there. Yep, Brian?
I don't know, maybe this is redundant, but I know I've done it before where I did a course where they had it where you some sources and uses before and you take them out. Like you add them, have called totals to make sure that the balance, is that being redundant, putting a column, like having our new sources that we have and our uses in making sure that they add up before we add them to the uses.
Well, we do that in the assumptions. You mean here, like the uses and the sources here?
No, in the balance sheet. You know how you have like our debits and credits.
Mm-hmm.
Like would it be useful to sum them up, like have like a subsection where?
I mean, I've seen here like a sum of the debits and a sum of the credits to make sure they match, and like a little check. I've seen that just to make sure that they check here. You could, but again, I don't do debits and credit. In the actual model, I do pluses and minuses, and they won't add up. But you can add that up if you want. See if they match.
How come if you do pluses and minuses,
Because these will be on the right side of the equation, and this will be on the left. I'll show you. You can do assets minus liabilities equals assets minus liabilities. That'll work.
still net out zero,
No, they won't. They'll do it. They will if you do assets minus liabilities. If you do on the plus column assets minus liabilities, on the minus column assets minus liabilities, that'll work. But otherwise, it won't add up.
So everything you add in should balance out, and then you take out the balance out.
If your total is assets minus liabilities, not the sum, right? You flip the signs, adding is going to double. We'll see. So those are the balance sheet adjustments in the simplest form. We'll do it again a couple times. One in the Office Max, once again in LBOs, because I know it takes some practice in terms of the concepts. But again, it's important to have those concepts. As I mentioned before, a lot of people just aren't taught with these concepts and are confused about how to make appropriate adjustments when new situations come about. So at this point, we have our balance sheet. We have our balance sheet that we can use to build our depreciation schedule, build our working capital schedule. So let's do that after the break. Okay, continuing. So now that we have this balance sheet laid out, what I would recommend is to transfer this balance sheet into the actual balance sheet that we will use as our historicals to build our projections once we're done with the cash flow statement. So underneath is the real balance sheet. Line items laid out, and again, in this template that we're building, it's easy when the line items match. We'll see in the Office Max case, it's going to be a little bit more complicated. So simply here, I'm just going to pull in cash from what we have above. So cell F152 is going to be equal to, up on top here, H111. And we're just going to copy down, right? Big Control D, right? So I'm just going to take everything because the line items match up. I'm going to copy all the way down, all the way through total liability and shareholders' equity. I don't care about the total formulas here. You can readjust them if you want to be completely particular. But when we do our projections, we will do that, right? So we're going to, and actually, instead of Control D, so I can hold on to the formats, I'm going to paste the formulas down. Didn't work. And this will be used to build our depreciation schedules and our working capital schedules. I'm just going to clean it up a little bit, remove these zeros, which were just there for headers. Okay? You guys all right with that? Okay. So now we have depreciation. And if you look down here as a refresher, nice to know on the exam, I think most of you guys were okay with the depreciation. Why is that funny? You're proud? No, I'm kidding. It's the working capital. It's the working capital that some of you guys struggle with. So we'll look at that. Okay, so property, plant, and equipment. The first thing we do is we pull it in from the balance sheet, right, as normal. So this equals in from the property, plant, and equipment that we have here. Notice this is a merged PP&E, and this may or may not contain write-ups or write-downs if we've had that in our balance sheet adjustments. So that's one big difference. So again, looking at the differences between a mini merger model and a full-scale merger model. A mini merger model, you're just adding depreciation and amortization as they exist within the individual entities. Here we have new property, which is okay, but that property might be written up, might be written down, it might have some other components to it that we'll see in the cases. It's a lot more accurate this way. And you want to be careful about the perspective. The perspective here is, which happens in most mergers, is We're getting an appraiser in. The appraiser is identifying all the target assets, identifying which ones are good, which ones we should take, which ones we should dissipate, which ones we should sell, which ones are evaluated appropriately, which ones should be written up and written down. He's going to reappraise all the target's assets and redepreciate from scratch. That's the perspective we're going to have here. That's another area where in the merger model, you're just adding the individual acquire and target depreciation might fall short of analyzing is what happens when the assets get reappraised and redepreciated from scratch. That's the perspective we're having here. So we're going to pull in the property from F-158. And we also depreciate CapEx. Right, so the CapEx comes in from our cash flow statement. On the cash flow statement, it's negative. Remember, we want to reverse the signs. So we're going to pull this in G192 minus, so we're going to reverse the signs from the cash flow statement. Scrolling up slowly, here it is. Remember, this CapEx is, in fact, a combination of the acquirer and target. CapEx is seen as operating. It's required for the maintenance of your core PP&E. We're going to copy this to the right. And we'll do the core straight line depreciation. Don't feel like you need this to be complete, right? I mean, let's just go through a few of these rows and you have the whole weekend to finish this. I want to focus on what's new and different in this model. And so as you know, so again, we're just keeping 10 years here. Typically, what would you do? Where would you get the rate of depreciation in a merger scenario? Yeah, the useful life. Where would it come from, Daniel?
I think you have to look at both companies and make
You
a
would?
determination on your own.
You would?
It's going to be more appropriate. You can either go into real detail and break everything out,
You could,
or you can
yeah.
try to take an average that you feel most appropriate.
You can do an average. What else? Any other ideas?
Remember the book you mentioned something that KPMG had, that table of how you depreciate certain.
That's for allocation to amortization. And I didn't mention that. Actually, no, I mentioned it when we did the mini merger model. But yes, there is a table in the book that I got from KPMG that focused on specifically what percentage of goodwill or purchase price over book value it could be allocated to intangible assets. And that table is based on past transactions by industry. So it's a good gauge. Although despite that table, we still typically use 20 to 25% HIL.
Is the IRS simply take that out, or is that only for me?
The IRS, well, to take what out? The useful life?
Yeah.
The IRS wouldn't do it. Somebody else would, though. Who would? Who would, and then what does that mean for you as an analyst?
Would there be a company that comes in and fair values everything?
Yeah,
So you
the
basically
appraiser.
take what it tells you.
Yeah, the appraiser would tell you. Now, you wouldn't, as analysts, you wouldn't have that information. So, right, part of this is how do you be an efficient analyst in this? Because that part doesn't come until the very end of the due diligence process of the deal. So, as an analyst, you would have to make some sort of assumption. Daniel, taking an average is good, but understanding that an appraiser is going to come in and redo everything from scratch where it's unknown. And they probably, while they're at it, they probably reevaluate your assets as well. Combine all the assets, reappraise everything. I would kind of err to what the acquirer's rate is as an assumption for now, and you can always change that. So as a default, we typically take the acquirer's useful life. They will depreciate at the acquirer's existing rates. You are absorbing all the businesses into the acquirer. So for an analyst, in terms of being an efficient analyst, I would start there, and then you can kind of tweak accordingly as you get more information. But at least you have it there, ready to be deliverable, so that, you know, as we talked about at the beginning, so it's not like I'm going to come to you and say, oh, where's the analysis? And you know, I'm waiting for the appraiser to come, and that's never going to happen, right? So you have to at least be efficient in moving forward with these types of things. So this is a template, right? So we have those numbers in there, but in the model we'll do next week, we'll get into that information. Let's model this out. Existing PP&E is going to be equal to the depreciation on the existing PP&E is going to be equal to 6360 divided by 10. This is straight line depreciation, so we're going to anchor the reference to that formula. Divided by 10, anchor reference to that formula, and copy this to the right. right? It's 636 in depreciation on that each year for 10 years, obviously. And we do that for each respective CapEx, right? So for CapEx in 2014, it's the 1100 anchored divided by 10. Okay, copy to the right, and so on. Okay, I'm going to do it really fast because you guys have done this, and I don't want to waste time, but I'll do it really fast, and then I'm going to send this to you. You can kind of do this again at home, so you don't need to have this done for what we're going to talk about next, but you would anchor, obviously, for the next year. We're going to anchor this in 2015, and so on. So get this done as much as you can, and then you have until Monday to get it complete. And I'll send this to you. Whoops. And so to keep this interesting, well, this is straight line depreciation. Straight line depreciation goes where? Income statement, flows into the cash flow statement. We'll link that up, but it's not really fair to link it up if you guys don't have it yet. But we can start linking it into empty cells. So anyway, we'll sum this up. Taking care not to include the years into that total formula. I see a lot of people making that mistake. Okay. And we will assume that we're going to accelerate the depreciation to create a deferred tax liability. Now, I don't know if you guys have faced this on the deals you're working on, but not a lot of these companies, especially the big Fortune 500 ones, accelerate depreciation for deferred tax purposes as their sole method of deferred taxes. So we'll see. We did it for Walmart, so I want to show you how it was done because you see it a lot in models. But when we do the case study, a lot of times we won't do it. We're going to depreciate, we're going to project deferred taxes differently. Right? Even though they probably will have some component of accelerating depreciation to create deferred tax liability, it's not always done that way. There'll be a lot of different ways, and we'll look at that. We'll see that with Office Depot, Office Max. But just to keep it interesting and to give you new modeling techniques, any guys working with foreign entities? Everybody, right? Sorry. Everyone's foreign entities. Okay.
That's how he's doing.
Where? All Latin America, or?
We're all very fluent in Spanish.
Okay.
My Spanish is
Well, see that? You didn't expect that out of the program.
And balance sheet items in Spanish.
Oh, really?
Oh yeah, you can test me on that.
So
On this working model, where do we put the dividends for paying yourself? I'm joking.
Oh. Wait, but I didn't get it. Wait, I'm slow. Oh, really?
Dividends that you pay for yourself.
In a public company?
Well, no.
What's it called in Spanish?
Nothing?
No, the dividends.
Oh.
Oh, failed the test already.
Depends if you want the real dividends or the fake dividends.
Wow.
It's called
But it's-
other liabilities.
Really? But it's public. It's for public consumption. Or no, these are private.
These are private.
Oh, these are private companies.
So they do.
Interesting.
So
See that?
you have investors you think would prefer not to have a.
They
Right.
don't speak Spanish.
Oh, there you go. Wow. I do not want to know that. Okay. Do you guys accelerate depreciation?
Yeah.
You don't use makers, do you?
No.
I hope not. That's the U.S. method. What do?
Well, for the Mexican companies, we don't accelerate.
You don't accelerate. Okay. So you don't accelerate. Nobody's accelerated. Okay. If you did, anyone working with companies in Europe?
I did one, but they didn't have any debt.
Okay, but they don't need to have property. You mean they didn't accelerate? They didn't have liability. Wow.
We have no, well, they didn't have any long-term debt or anything like that.
Okay. I mean, well, maybe you want to add to your model, because let's do a declining balance. Have you guys done a declining balance? That's where I'm getting at. I think it's good to know. It's good to know, especially if you're dealing with foreign entities, right? The non-U.S., the most popular non-U.S. tax way to accelerate depreciation is declining balance, right? So declining balance, how do we begin? So if you guys don't have the straight line, don't worry about it, come back to it. Where do we begin for declining balance? Well, where do you start? What do we need?
The formula.
Yeah, but no, the formula for what?
Well, we need to know useful life, which we have,
You have the useful life, for what purpose?
because then we're gonna take 1 over useful life times 2.
Yeah.
We need to know what the original PP is.
You do, you have that.
Sorry, subtract it.
And the rate.
Right.
What's the key difference between the declining balance, and you said times 2, so that's double declining balance. Okay, let's use double declining balance.
Okay.
That's fine. I mean, declining balance is a bit ambiguous because you would multiply the reciprocal of the useful life by some factor. And it could be 1.5, it could be 1.25. If it's 2, it's double declining balance. There's no such thing as single declining balance. But what's the key difference between that? The makers and the declining balance.
Well, makers, you have percentages that stay. Double declining balance.
They don't stay the same.
Have a base that changes every single year.
Yeah.
But I mean, it stays. I mean,
The base stays the same.
Yeah, but with double declining balance, you're going to have the different. You're going to start with X, and the next year is going to be X minus whatever you
Right.
depreciated, and then X minus
Right.
what we depreciated.
Right.
So it's going to get.
Yes. AJ, you're going to say something.
You're just essentially gonna have you have a write-off more a lot up there, but double the time than makers.
Not in this case. Why? The double declining is going to give us 20%, right? 1 over 10 times 2. Not always. But the biggest difference, let's say, in the mechanics, is the fact that in the declining balance, I think, Daniel, what you're saying is the rates are the same, but the balance of the PPE is declining. We're taking the net balance after depreciation and multiplying it by the rate each year, giving us declining depreciation. Let's model that out. Whereas the idea for the maker's percentages is you don't have to deal with declining the balance yourself. You take the original core balance and multiply it by a percentage that's declining. And the way they calculate that percentage is they bake in the implied impact of a declining balance in there. That's the idea of makers. There's a formula where they've actually calculated, okay, well, if the declining balance is actually X% of the remainder, and that's how those percentages decline. So in the maker schedule, we multiply the same core base by declining percentages to get declining depreciation, and the declining balance, the percentage is flat across the board, but it's being multiplied by a balance that's reducing. So let's do it that way so you can see the difference. So in this case, it's going to be always 1 divided by the useful life times 2, 20%. We can copy to the right, 20%. Yeah? You guys have that? Okay. I'm going to anchor this.
So are we not doing makers in this case?
No, we're going to do double declining balance. Let's just to keep this interesting, because you've done makers before.
So, okay, so it's 1 divided by 10.
Yeah, times 2. Yes. And maybe a little bit redundant, but to keep order, and you guys could just keep it, one way to do it is just to keep this one row. I'm just going to copy all the percentages as 20%. I'm going to anchor the reference only to the column. You know you can separate the anchors, right? I'm going to anchor only the reference. It's not so important, but only, just to be completely accurate, only the reference to the row. I'm sorry, the row. So when I copy down, the 10 doesn't shift down, right? The reference to 194 doesn't shift down. But it's okay to copy left and right in the event that in a different year, those years might change, right?
In this particular case, because it's 10 years straight through, you can just anchor the whole thing.
Well, yeah, but I mean, just to handle the possibility of them changing a CapEx life at some point. So this way, when I copy this down, as you know, the reference to the row stays fixed, but the column still shifts, right? And I'll just do that each year. I'll just, now that that's set, I'll just copy down. I'll copy down. And so on. Maybe a little redundant. You can do it. You can simplify by just having one row of percentages, but then you just have to be a little bit more complicated with your formulas underneath. Okay. What I will do, everybody there? Okay. What I'll do now is I'm going to have two sections underneath because we need one for the depreciation, but one for the balance that's declining. So what I'm going to do is I'm going to highlight rows 213 to 221. I don't need a total. Control C, right? And then I'm going to go to row 213. I'm going to hit Shift Spacebar so that when I do Control Shift Plus, hopefully it'll include a copy of everything. Yeah, Control Shift Plus includes a copy of everything. It's going to copy everything we have here, but I'm going to rename it as declining balance. Okay? Yeah, Control Shift Plus. Yes. Question on that? You know, there's a couple ways to do this, but I want to make sure that you have the same core concept.
Do you copy the whole column or just the, the whole row or just the?
No, just the labels. No information in here. Oh, did I accidentally? Nope, just the labels. No other column, just a bunch of rows here. I just added, what do you mean didn't get, I just added 10 rows. I just added 10 rows underneath the percentages. Here are the percentages. And the way I did that was I highlighted you have accelerated depreciation. If you want to know the quick way, I mean, you don't have to do it this way. You can do it however you want. But the quick way is highlighting these 10 rows, accelerated depreciation, existing PP&E, and I did Control C. And then I went up to the top of that section and hit Shift Spacebar, which highlighted the whole row, and then Control Shift Plus. That added that. The other way you can do it is just add 10 rows above this and copy and paste these names. There's another way to do that. You just want to make sure you're adding these 10 rows. Yeah, it takes time to get good with these hotkeys and stuff and adding things like that.
So we added the grand balance to.
Yep, that's correct.
So we did that. So can you just scroll up to the other one? So it's in the reference size for these bullets. So it's before the actual values that we calculated.
Yeah, after the percentages. After the percentages we just did.
So that's still our accelerated depreciation.
This is straight line up on top. We calculate.
But in the 20% is accelerated.
These are the percentages we will use for the accelerated depreciation. Yes.
I still trying to finish.
You're trying to figure out. We didn't put it. You mean the 20% or? You're trying to figure out.
Yeah, I'm just trying to like you added on the accelerated depreciation that
Well, the percentages were here. Underneath that is where we added the new section. We didn't put any information in yet. We're just adding rows to prep for that. So you have the percentages in there?
Go to row 213 and just add 10 lines.
Yeah, we're just adding 10 lines. I'll tell you, I don't know. Are you guys, John, how do you do with the Mac? Yeah, it's just so difficult to add rows and things like that. Yeah, it's in his defense, it's tough to do little things like that. Yeah.
No, I like it. I mean, the reason I did it is because wherever I go, I have a map. So I just say it on the idea. And I actually just sold my PC like a couple weeks before I came up here and bought a map. So
Yeah, you just do like you do on the browser. There's a whole.
Yeah, you're good.
Yeah, Bob, you're missing out, bro.
I do have like,
You have your
Bobby was so.
Okay, let's continue. At this point, I think, well, I know, to start by pulling in the existing PP&E. Let's pull in the starting balance that we will have decline as we calculate depreciation off of that balance. So the way I recommend doing it, and there's a few ways to do it, is G214, I'm going to pull in the starting balance that will decline as the years progress. So I'm going to pull in G214, I'm going to pull this in from the top F191. This is the starting balance for PP&E. Got it? As the years go on, we'll have this reduce by the depreciation expense. So G214 equals F191. The table underneath, our depreciation table, is where we're going to calculate the depreciation off of that balance. So this is going to be equal to the 6360 times the 20% that represents the 20% of PP&E depreciation in that year. Got it? Multiply.
So
1272.
what we do is so the following year will be the difference between that existing and the depreciation expense.
Yes. H214, yes. You guys got that? Yep. 214 times 205. Got that, Brian?
You know what I did? I went ahead and actually did the record report, so I had.
Oh, okay. All right. Well, I'll email this to you so you have two versions. That's fine. And then so what Sammy was saying was right. So now we have G. Next year, our balance is going to decline, right? It's the 6360 minus the 1272. So we have a smaller balance from which to calculate our new depreciation, which is the 5088 times that 20%. We can actually copy everything to the right at this point if you want to. But what you're doing in H223 is going to be the 5088 times the, what's that, Dan?
I like this.
Yeah, times the 20%. I figured you'd enjoy it. I figured, yeah, you might. Daniel's going to love this. I was so excited. And we can copy this to the right. The whole thing. And we repeat that for each year. Yeah, we just copy to the right, but obviously the importance is to understand what's going on. Decline, 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 decline. A fault of this method is you never really get to zero. The makers, the percentages, if you add the percentages, always add up to 100%. So you're always depleting 100% of the property. Try it again for CapEx. What do you do for CapEx? Row 215, we pull in the balance, 1,100. Yeah, and you multiply 1,100 times the 20% in the next year. This is where I thought maybe you think it's redundant to have these percentages staggered, but it actually helps when you can just copy things to the right. You guys okay? Anybody want to look at a formula? $1,100 up above CapEx G192. Yeah. Down underneath G224 is a multiplication. 20% of that is our depreciation. Next year, you got it, good. Next year we decline. H215 is the 1,100 minus 220, right? The balance declines, and we calculate new depreciation off of that, right? 880 times 20% of that. And then you can just copy everything to the right. And so on. Practice this over the weekend. We'll do one more, just so you got it, but I think you got it. There's one more row here. H216, it's the new depreciation for the next year. That's the 730. Just the new CapEx. Underneath, 20% of that. 730 times 20% of that. The next year, 730 minus 146. At this point, you can just copy everything to the right. Okay? Once we have this done, I want to get to calculating the deferred taxes off this and linking this up. So even if you don't have it done, and I don't have it done, let's just link things up. So what I'm going to do is I'm going to total up row 231 by highlighting M223 to M230. Even if you don't have the depreciation schedule done, let's get the links in. Let's total up what you have so far. Don't worry about matching the numbers. Make sure that you have the totals, no matter how far you've gotten. Go back and finish that table, but let's see where the table goes. Finish the table over the weekend. And then what? What's that, Sammy?
We find the difference and multiply by the tax rate.
Yeah, difference multiplied by tax rate. The difference in depreciation will help us determine our deferred tax liability. Accelerated minus straight line. Even if you didn't finish straight line, just total it up. Times tax rate, not 1 minus tax rate. A few of you guys did 1 minus tax rate on the test.
So I thought, now for you, you've got negative numbers because it's not complete, but mine is done, but I still have negative numbers. Does that make sense?
Yeah, at some point, it'll no longer be depreciating. I mean, the depreciation will always be depreciating. The depreciation will no longer be accelerating, and then you're paying back your liability.
So then you have a negative
Yeah.
deferred tax asset?
Yeah, well, it's a negative liability. You are paying back the liability. Building liability, positive, 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 and negative, 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 pays down, pays down, pays down, pays back. If you've done this completely, for all 10 years, the sum of these flows should be 0. You've built the liability, and then you've paid it all back.
Differences?
No, the sum of the deferred taxes when you multiply by the tax rate should equal 0. Yeah, or the sum of the differences. Yeah, will also be 0.
I must have done
Well, no, you got to do it all out to its full life, 10 years to see that.
Yeah, so I've got it all the way up to 2020.
Yeah, but are you still producing CapEx? You gotta stop it at some point. You just copy to the right? So you're still building CapEx. You gotta stop it at some point and actually have the depreciation and depletion go to 0 for the.
So even if the SIP is complete, it won't add up to 0, all those.
It will.
Okay, they don't have it 10 years.
Yeah, well, it will if you build it out for 10 years.
Right, but for this.
For this, it won't. For this, it won't. Yeah.
Fair enough.
Okay. Multiply by the tax rate. Pull in the acquirer's tax rate. Make sure you're pulling in the same year that's equivalent to the year that you're looking at in column G.
Do we get that from the assumption or no?
From the income statement. It's got to be the same income statement tax rate, always. And multiply. So again, we're at different stages of the model here. Don't feel like you have to match the numbers. I just want to make sure we're covering where they should go before the class ends, right? Let's get the links in. And where should this go? Where do you think? Okay, well, yeah, this goes into deferred tax liability. So no matter what stage you guys are at with the depreciation schedule, we can still link row 234 in. So let's link in row 234. Deferred tax liability in into row 73. Did I get it wrong? No, deferred income taxes, sorry. So G73 equals G234. Pull that in. We can take the highlights out. You guys have that? Yes? No? Okay. What else links up?
Cash flow as well.
Cash flow, which comes from income statement. Income statement depreciation can be pulled in from the depreciation that we have in the straight line that we just calculated, the 746. Copy that to the right. Good. The amortization, G26, we still didn't do. I mean, we calculated, we didn't link it in. Comes from our assumptions. 52.1, we calculated. Amortization doesn't change. Anchor it.
So for the income statement depreciation, we use the float depreciation.
Always. Right? The only purpose accelerated depreciation serves is to create a deferred tax liability. Accelerated depreciation does not go anywhere. And we want to make sure this depreciation and amortization links in to the cash flow statement. And it should automatically, because we've already set up those formulas to do that.
Thank you. This is the formula for the intangible asset as amortization.
Yes, the assumptions. And then we are ready to do the working capital. And it's harder to see in a template because it's already there. But we're very much going to have to create our own working capital from scratch because it's going to be a combination of items from the acquirer and items from the target. So we'll talk more about how that blends. But as always, I'd recommend looking at the balance sheet to identify which line items reflect working capital, and then having to go back and think about how are we going to project these line items going forward. A couple other things to consider that's different in a merger model, aside from the fact that the line items are going to change between the acquirer and the target and combination, is the fact that we have synergies. These if any working capital line items that are projected off of operating expenses might change because we have synergies involved. So we need to consider that. Always you can look to the balance sheet and determine which line items are related to current assets and which line items are related to current liabilities. Easy in this template case. AR, inventory, prepaid expenses, other, right? Any current asset that doesn't include cash is operating working capital. We're going to have 4 assets. Liabilities, AP, accrued salaries, other. We're going to have 3 current liabilities. So you'd identify them in the balance sheet, create your own working capital from scratch that has those 7 line items, and find some way to back into it and project, taking care of also including the synergies. And we'll do that soon. I have 1 minute. Whoops. In case anybody already has this done, I'm going to pull it in real quick. If anybody has this and want to match numbers, it's just we really don't have the time to start a brand new schedule right now. Why did that bold? So I'm going to pull that in. I can just copy this down and to the right. And I'm going to, actually, I could just copy this formula down. It should work. Right? Actually, I'm just thinking of a quick way to do this. I can just pull this in. I can pull this in. I can pull this in. This is a real quick way to do it. See where I'm getting at? I'm not insulted by that yawn. Thursday. It's the last day of classes. And then just copy down, right?
I got a question too.
Yes, John.
On breaking to Wall Street and
Yes.
talking about some M&A,
I'm off.
they were using,
You just gotta copy one,
they were talking about like the cost of stock and the cost of equity. It's like 2 separate items. Now, are we combining that in our discussions, or what is it?
If you have different classes of stock, then yes, the cost of stock could be different than the other classes. We will see that in the Heinz leveraged buyout where Warren Buffett has preferred equity in there. And then 3G, you guys know 3G, Latin America? They have a different equity. We're going to look at the costs of those different forms of equity. Yeah, we will look at that. You got to be willing to go down there.
No, thank you.
Rio. Hey.
Is that where they're based?
Yeah, there's nothing in
I'm
Rio.
terrified of food zone.
I'm terrified of Mexican accounting.
You're terrified of it.
Yeah.
You shouldn't be.
Oh, but
It's a little
I am.
You should start a new computer.
Yeah, I haven't had it.
You speak Portuguese.
Didn't you say one of your family's cars got shot at? Thanks.
That happens every
You're
day.
not making a good case.
This is what you guys talk about? I can't imagine. Okay, yes, Tosin. H214. We're slowly declining the balance to 15. It's the same idea. If you got H214, you can copy it down. It'll work. If that helps. You're not getting it? Different rows? I can look at it after class. Everyone else has this?
Yes.
More or less? I mean, I know Brian, you have a different version. The tricky part is then, Brian, you're going to be working off the different numbers from here on out. Well, one day we're going to include this. Got it? Makes sense. Okay.
See, it was the 80s and before.
So
you have to make sure these are covered across as well.
now that this is done, once we have working capital, we can finally link that into the cash flow statement. We will have a finalized cash flow statement. that we will use to build our true balance sheet, and then we'll do the debt schedule. So Monday I think might take more than Monday, but I want to go through it quickly. I want to tie this up, and then start getting into the Office Depot Office Max case. So if anybody has any questions, please let me know. I will email this out, and we'll see you guys Monday. Tosin, I'm happy to take a look at that. Thank you.
They're in a meeting there.